Senator Paskvan.
Thank you, Mr. President. I move and ask unanimous consent to be allowed to speak upon the math problem in Alaska's production tax system.
Without objection, so ordered. Senator Paskvan.
Mr. President, as I've been saying for the past couple of months, we have a math problem. Before we can advance sound tax policy for the state of Alaska, the state's policy makers need a better understanding of the math, the numbers. And by numbers, I am referring to a complex set of interrelated data that includes not just tax rates, but also tax credits offered by the state to the oil industry. These include deductions against an oil company's tax liability and cash payments to incentivize specific exploration and development activities. On Sunday, April 17th, I submitted a series of questions to the Department of Revenue. The overarching intent of these questions was to identify all categories of credits that the state of Alaska invests in the oil industry, to identify all dollar values for the individual categories of the credits, and to depict the impact of each category of credits upon the revenues ultimately received by the state of Alaska. I very much appreciate the Department of Revenue's cooperation in helping me to address this important math problem. On Sunday, May 1, I received information from the Department of Revenue about the state of Alaska's actual and forecasted production tax on oil for fiscal years 2010, 2011, and 2012. This information is helpful to a better understanding of the oil tax issue, and I am pleased to share it with the Senate and the public who may be viewing today. The production tax is a net profits tax. It is only imposed on profits. From the gross revenues, royalty, TAPS tariff, and marine transportation costs and operating and capital expenditures are deducted. According to the Department of Revenue documents that I recently received for the years 2010, 2011, and 2012, between $7.2 billion and $9 billion per year are deducted from gross revenues. The production tax value, or PTV, is the amount reached after those deductions are applied to the gross revenues. It is at this point, the PTV point, that Alaska's production tax is triggered. Only if there is a profit is there the potential for the imposition of Alaska's production tax. Profit oil is calculated after 1, all royalty ownership is subtracted from the gross, 2, all costs are paid, 3, all expenses are accounted for, and 4, all expenditures are deducted. Many in Alaska have heard that the Alaska tax system currently imposes punitive rates of 75% or even 80% or even higher. Those statements are not connected with current reality. Those statements are false. The Department of Revenue recently released charts are helpful in presenting a more accurate representation of the truth. In Alaska, the imposition of production tax is not a simple application of a base tax rate and a progressivity rate. Why is this so, Mr. President? Because of credits. Credits, according to the Resource Handbook, quote, are a critical component of the state's overall tax structure, close quote. And continuing in the Resource Handbook, quote, sound tax policy involves moving beyond the collection of taxes into understanding the business perspective of the state's taxpayers, close quote. Mr. President, I could not agree more, and I would add that the state must also apply a business perspective to the work that we do. Credits must be understood by the legislature in order to fully appreciate Alaska's total production tax system, its net profits tax system. The application of credits to the production tax value reduces the effective tax rate. Credits may be applied by the oil and gas industry against taxes that are owed or even cashed, even if they owe no taxes. The public should know that there have been billions of dollars spent by operators who owe taxes because they're already producing oil, and that there have been hundreds of millions of dollars spent by operators who owe no taxes because they have not yet produced any oil. That is, they are still in the exploration or development stage that must occur before the production stage. There are more operators working in Alaska now under the current tax system than the previous tax systems. These operators are spending hundreds of millions of dollars that will likely lead to increased production. That is the purpose of the credit segment of Alaska's production tax system, and the reason that the state has made approximately a $4 billion investment through its credits in the state's oil industry through fiscal year 2012, with billions more to be invested by the state of Alaska under its credit system in the next 5 years. Credits that are paid by operators that owe taxes range between $350 million to $465 million per year. And again, we're referencing fiscal years 2010, 2011, and 2012. Credits that are paid by or that are issued with respect to operators with little or no production, in other words, they owe no taxes, range between $250 million and $430 million per year. And these monies are paid to these operators from the state's production tax credit fund. Cumulatively, these credits, which are either deducted from the tax liability or directly cashed, range between $650 million to $880 million per year. This is Alaska's yearly investment in the industry. After applying the state's investment by way of tax credits, the net amount of revenue retained by Alaska is substantially reduced. The effective production tax rate, and we are talking now at the range of $75 a barrel to $95 a barrel, becomes 23% to 31% of the tax on production tax value, the PTV number. This leaves 69 to 77% of the profit oil in the hands of industry. The members of this body and the public may be interested to know that under this scenario, the state's tax rate is just 12.4% to 18.3% of the gross revenues. Let me repeat that. At $75 to $95 a barrel, the state's production tax rate is just 12.4% to 18.3% of the gross. Now, does this mean that the production tax analysis need not continue, Mr. President? And the answer to that is no. The analysis must continue, and it shall continue. Alaska's production tax credits greatly benefit industry at lower oil prices, when the deductions and credits have a big impact on the oil company's bottom line. It is frustrating that no audits have been completed by the state of Alaska's Department of Revenue, so that better information received from those audits as to whether the credits are working would be available to us as policymakers when we make our policy decisions. The Senate is looking into this, and I know that to their credit, the Department of Revenue is also dedicating considerable time and attention to completing the first audit of the ACE's tax system. Just as Alaska's production tax with credits benefits industry at lower prices, the state of Alaska benefits from progressivity at higher oil prices. At higher oil prices, the dollar value of progressivity exceeds the dollar value of the credits. One of the questions raised at higher oil prices is whether an unhealthy financial relationship develops between the state and industry. This question must be addressed. The public should know that an analysis of Alaska's production tax system, including the impact of the credits to both the industry and the state, continues in the Senate. The process shall continue during the interim, and the process shall continue next session. I want to thank the Department of Revenue Commissioner Brian Butcher, Deputy Commissioner Bruce Tangeman, Master Auditor Lenny Dees, Petroleum Economic Analyst Sherry Nienhaus, and Petroleum Economist Dan Stickel. And I also want to recognize all of the valuable input that has been submitted by industry. Like many in these chambers, I have met with Trond Eric Johansson and John Minjay, Bill Armstrong and Ed Duncan, and many other oil industry executives. I too have benefited from discussions with my friends from the Alliance, AOGA, the Chambers of Commerce, and the Alaska Native Corporations. These people have worked with me and each member of this body and have provided substantial information which is helpful to this Senate. I look forward to continuing this good working relationship with them during the interim and during the next session to ensure that the state's positive working relationship with the oil industry continues far into the future, Mr. President. In conclusion, the public should know that the Senate is seeking answers on the topic of the split of profit oil as discussed here today. The public should also know that the Senate is seeking answers on the topic of oil and gas employment, and in particular, why so many non-residents are working and why so many Alaskans are not working, even though industry employment numbers are at all-time highs. The public should know that the Senate is seeking answers on the topic of throughput. There is reliable information, Mr. President, that the likely operation of TAPS is at least until the year 2047. And this is likely without any potential contribution to throughput from heavy oil, or shale oil, or ANWR oil, or NPRA oil, or OCS oil. Based on the available evidence, Mr. President, I am confident in saying that TAPS will continue to operate for decades. There are billions of barrels of conventional crude remaining in Alaska's central North Slope. The public should know that the oil industry has recently invested hundreds of millions of dollars in rebuilding the above-ground North Slope infrastructure. Industry has deducted these costs and received credits under Alaska's production tax system. The public should know that the oil industry has recently invested hundreds of millions of dollars in well workover activity, rebuilding the below-ground North Slope infrastructure. And industry has deducted these costs and received credits under Alaska's production tax system. And the public should know that there are companies without current production who have also recently invested hundreds of millions of dollars on the central North Slope in pursuit of new oil fields. Mr. President,